Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, June 27th, 2023. It's past 5 p.m. now. Markets are closed. I had to do a few things, scrambling to get out of town. As I mentioned, I'll be on the road tomorrow, and we have the holidays coming up. This is usually probably about the other than the week between Thanksgiving and Christmas, the worst time to trade. Volatility, volumes drop off. And then what happens is you get more whipsaws, false breakouts, everything else. So that being said, a lot of traders are gone on vacation, professionally and retail traders. So, but with that being said, I'll give you updates if I see anything, come across trade ideas. I'm starting out here because I came across this one today, just looking over a lot of different stocks. I'm always looking for ideas. So I'll start here, and then I'll go over the usual or the recent trade ideas that I've shared, mainly the equity markets, the semis, treasuries, commodities, natural gas, wheat, and that kind of stuff. This one is HA, Hawaiian Holdings. That's Hawaiian Air. And you can see what you have here is a big divergent low right there. A recent breakout. Now, I didn't see this one until today. You had resistance here right around $10. That says $9.96. Let's round it up, call that $10. And rallied into that resistance, which is defined by these reactions here. Had a pullback to almost backtest the line, and then boom, big green candle today on volume, high volume, and it took it above that level. Now the markets are closed, so the way I would play this one, I won't be around tomorrow. If you like it, you want to see follow through. You want to buy it above 10, not below 10. If it falls much below 10, it can dip a little bit back in there, but you want to stop somewhat below. Someone's going to be relative to your price targets. I have a minimum target zone right here. It says T1 zone. You know, it's a confluence of, you have a lot going on here. You have a primary downtrend line. Let me roll back here. First and foremost, that will most likely produce a reaction if and when hit. You have a price resistance zone from about 1172 down to about 1136 or so right there. And then you have above it is actually another resistance level in case it pops right through here with a momentum fueled overshoot, meaning a strong rally up, and then it would probably come back in and back test the trend line. And then you also have just below it the 200-day moving averages. That's these blue and red lines right here. And that's tended to cap every advance. We popped it briefly here. You overshot those the 200s right here, but then after a day or so fell back down below. So you can see, like many stocks, since the bear market started and it first took those out, they've capped it as resistance. So it's a logical bear market target, and more bullish if it could pop through there. So, you know, if it does, my best guess is going to run up out here, hit that target zone, at most pop over there, and then maybe a secondary entry if you took profits. And, you know, it's worth it if it hit it. You know, if you buy it around 10 tomorrow, assuming that's where it is, not too far above it, you're talking about a 15% run up to the downtrend line there, give or take 16%. So anyway, want to share that one with you. And now let's get into the equity markets. QQQ. Here's that, you know, this is just an update to the earlier one, video earlier today. 350, 770-ish, nice, pretty nice support right there. A lot of reactions. We came down. The near-term downtrend is still intact. We took out that minor downtrend line, which we've had 1, 2, 3, really the minimum number of reactions. It takes, in my book, at least 3 distinct reactions to validate a trend line, because any 2 points can be connected at random. So it's not a super well-defined one, and we're above it. And when you turn off all the lines, remember, this is what I was talking about earlier today, you still have a series of lower lows, because we never took out that previous reaction low, nor that one. And so lower highs so far and lower lows. And, you know, if we do this tomorrow and then take out that low, which again, that's going to be your next sell signal, a break of 357.70, or, you know, yesterday's lows. That was the final 60-minute closing candle of yesterday that closed right on that support. So that's your next break of support or objective short entry or re-entry if you played the long bounce today, so forth and so on. Likewise, you know, if you shorted here, we had that, pointed out that post-Fed breakdown, but that one I said take with a big grain of salt because it happened immediately in the wake of the Fed. Then we went up and then had a clean, definitive break of the trend line, and so we've been zigzagging down since. So that's what the Qs look like. 15-minute chart, same thing. Remember, we had the 15-minute divergence there. And as far as Fibonacci retracements, I covered those earlier today. We were Today we were a little below the 38.2 when I did the last video, and we closed right a hair above it. So we're still within a typical counter trend bounce level, if that's what this is, which is what I still suspect it is based on what I'm seeing in the charts, and then followed by whether it starts from where we closed today or finish the day, or a little marginal new thrust higher. Again, anything much above that 61.8 fib, it doesn't completely mean that we can't go lower, but it starts to take out previous reaction lows and just kind of I can tell you this right now, I certainly wouldn't be adding. You can add shorts up to here. Really ideally right here, I would wait for a reversal at this point. So this was, and still is, still aftermarket session still going on. You could add here and stop somewhat above if that's your thing. SPY, let's look at that real quick. SPY, same thing. This is a 60-minute chart of SPY. There's your fibs. We closed right on. Let me make sure. Yeah, I do have, these are the regular session trades. Zoom in nice and tight. And you can see this is the closing candle. We closed at 436.14, right on the 38.2. So a typical, so far, typical counter trend rally. And we'll see if there's more to come. You have a little minor uptrend line right here. So, if and when we crack that, whether we go up a little more first or crack that tomorrow. And then just like QQQ, ideally you want to see the recent lows get taken out to open the door to more downside. Hit on the futures. That's the 15. Here's the 60-minute chart. So that downtrend line on the 60-minute chart at NQ, we're pretty much right on it, is where we close the day. These still trade after hours, so that that's where we are. And remember, I showed you earlier today, maybe we can go down and get that one last thrust down to hit that trend line target I've been looking at there and eyeing, and or that just below it, 14,700-ish, and then maybe get a divergent low with gives us a little more bounce. But if we don't, we go through there, and I'm still very much open to that. There's your next target. Again, everything covered earlier, nothing new there. Yes, and that's the catalyst today. That's what I made sure to get out to you this morning. After that NQ post, said definitely want to watch this because that would most likely trigger a pop. And there's the pop. Broke out of a very well-defined downtrend line. A lot more reactions on the ES, the S&P 500 futures, and it's given us that. So that's still, what I consider a max bounce target zone to still keep this, bearish, near-term bearish scenario or bearish trend intact. Anything much above that just really starts to make a hard case. I certainly wouldn't, add to any shorts or take new shorts if you don't have any above that level and above the levels I just showed you on NQ. And the related note would be the semis. We shorted that one right here. It was posted as a setup before it broke down. Then you broke down. That was your sell signal. So it's still profitable. But of course, with the markets bouncing in tech, QQQ, you're going to have the semis. They just have a higher beta, just like it fell more on the way down since entry, dropped about 5.5%, which is better than the 4% or so in the NASDAQ 100. You're going to bounce more in up days. And then I think almost certain the last update I told you, any bounce back to S2, that was support. See, S1 was first support level. That's what S1 means. TL is trend line. So that was the first support level, broken sell signal. S2 was your second support level, sell signal break there, back test, rejection, and we're right back to it. So S2, support once broken, becomes resistance. So this is now the first resistance level, and we're at it. And so that gives you, if you took profits or you were scaling in, looking to add more, this is, and still in the after hour session, an objective place to add. Go up here much more than that. Doesn't mean you can't go down. It's just, to me, I wouldn't do it. I would hold off and wait for another signs of reversal. But I still very much like this trade and still very much favor another drop, another leg down to that second target there. That's going to be about 12% from where we're at now, if and when hit. Okay, I threw out the 10-year, and quite often I'll trade. I usually trade the 30-year just because you get more bang for your buck. It has a higher duration, meaning a duration is how much a bond moves in percent in in response to a change in interest rates. 1% drop or rise in interest rates affects, bonds that move more have a higher duration. That's just simply due to the longer maturity. So you get more bang for your buck. However, I like the charts better of the 10-year. That's just the sweet spot I'm trading now. And last update I gave you was right here, and on the futures. I'd really say watch the futures. Pros typically trade the futures. Retail traders will trade the ETFs, but we need to take out this level with conviction. So what you're looking at, we took out the bullish falling wedge right there. That was the breakout. And there was the back test, rallied up, and we continue to consolidate in this area. So we need to pop that. And that would, as I said before, treasuries typically, not always, but usually, especially during corrections, move inversely to the stock market. When the stock market is selling off, especially in a correction that has people worried, you get that flight to safety bid in bonds. Bonds go up. So a breakout at that and a pop up to T1, especially any of these potential second, third targets, would most likely, not guaranteed, but most likely correlate with that next leg down in the stock market I'm talking about. But as I like to say, resistance is resistance until unless broken. And then when you look at the futures, that level is even better defined. This is the line I gave you the other day right here. And so we've been, again, consolidating. Again, this is just the futures version of that IEF we were looking at. And so no breakout, no buy signal. So that's still, I had a buy signal here. It's still an objective long. We're nowhere. We're right where, pointed it out. It's just moving around sideways. But that's still the first target with a potential second, third target, depending on how things go. Could have sworn, I know I did, after I did that last video, I set a line there so I could set a price alert. It kind of vanished. Sometimes it does that on this program. I want my alert to tell me if it triggers outside of active trading hours. And that's that. So call it if you don't have a position, a potential setup. If you don't care to trade treasury bonds, I like to diversify, but if you don't trade them, at least watch it because it could give you a tell on the stock market. And that wheat trade, don't put all your eggs in one basket, diversify, use proper asset allocation, things that have no correlation to one another, such as wheat and the semiconductor stocks, for example. That's been a long trade. And then yesterday I pointed out, right as it was starting to crack this bearish rising wedge, said, it's time at least for me to, reverse that from a long to short for a pullback trade. And I covered a little bit above, as I told you this morning, a little bit above. This is a nice support zone, but that's a ideal target. You have two major reactions there. And I told you also, and I'll show you one second, I would look to exit, or I'm sorry, re-enter, add back into that position. I started just scaling and I didn't take a full position there. And down to, but not below T1 on the daily chart of wheat, the wheat ETN. And that's going to correlate roughly with that. You can see two reaction highs there. Here, let me show it to you. So this is what it looks like. So we hit T2, consolidated on it for a few days, and then those 60-minute divergences played out for a pretty sharp pullback. And there's really good support, pretty decent support, I should say, in my opinion. So again, I think it's objective to scale, re-enter if you took profits there, or maybe you didn't take profits. You didn't know how far. I didn't know if it would pull back for sure or not. Figured it probably would, but let's say you're just, you bought the breakout, and then you bought the break over T1, but you plan to continue as a long-term trend trader to scale in. Well, this is where you add. And then can you add below? Yes, you can, but I just problem with trendline backtests, I always say, is that trend lines come in at lower and lower levels every day. So you could backtest this thing for a while, and you're going to get underwater. If I would add here, stop out somewhat below, and then if it backtests and starts moving up back above, we can always re-enter later. So as of now, like I said, still profitable, still an active trade. Those are your levels to, kind of swing trade it. That's what multiple targets are there for, to take profits along the way, recycle in, out if that's your thing. Or just some people just want to take the early profits on these trades and move on to the next one. And UNG, same thing, big divergent low on the daily chart. Well, hit T2, pretty much for all intents and purposes, you can see close enough hitting that T2. I'm sorry, hit T1, T2, pulling back, like everything, it's kind of not everything, but like wheat, it got quite overbought on the on the near term time frames, and you have some 60-minute negative divergence right there. And so, I had different targets on the 60-minute chart than I do on the daily. But I still like it longer term. Pullbacks, you look for trend lines. My 60-minute chart I had to, on the futures, they rolled. So it's now on the new contract, I have to update and re-annotate that chart. All my annotations drop off when they roll the futures. So anyways, long term still looks good. As of now, I just don't have a very, very strong convictions here. I did started to mark up that 60-minute chart. Let me show you that, of the futures, that is. Okay, so this is NG. The last one I was on showing you before was the July, highlighted the divergent low, the breakout, it's been moving higher. But then you can see, just like on the 60-minute chart of UNG, the ETN that I just showed you for natural gas, this one just put in a divergent high here on the 60. So you pull back targets, potentially this uptrend line, and max pullback target doesn't mean it can't go lower, just where I would still be a buyer, potentially, depending on how the charts look at the time, would be this uptrend line. It's very early, 1, 2, 3 reactions only right now, but that would still, the daily charts would still be fine at this point. Anything much more than that, just so anyways, that's your scale-in zone if you want to, if you want to pull, if you're short and you're shorting the pullback off the divergent high and rally into resistance in that second price target, and you're looking where to cover, I'd be careful. I'd be really careful shorting. Like with wheat, one day I just wanted to came that quick 60-minute wedge break, juice up the returns a little bit and then get back in. I didn't want to not going to try to get cute and nail the bottom of that, like I said, and that's why I didn't go back into full position if it falls a little more, which it did. So where I took that first lot, again, I'll be on the road tomorrow, but if I'm can pop open the laptop and I see what I like, I'll maybe add another lot to that trade tomorrow on wheat and natural gas. I'm just kind of waiting to see a good re-entry point right now on that, and I took some profits on it recently. Let's see here. Okay, yeah, euro. That's what I should cover. Okay, last couple of weeks, or for months now, I should say. For years, I've been highlighting the euro and the dollar, US dollar, or the euro. Euro is just basically an inverse chart of the dollar almost because of its weighting. Nearly 2/3 of the dollar index is kind of by. So we had that breakdown. That also correlated with the leg down in gold and silver. Then we had a bounce. Gold and silver rallied. But this is a level I told you I favor this rally to stop and probably get one more leg down. And so far, look at that. There's been some volatility lately in the currencies, but I mean, it's consolidating around that level like a champ. I define a reaction as one of two things. When you're going up, a reaction is a reversal off a resistance level or a consolidation, and that's what that is. So, we've been consolidating on there. It's been volatile, moving up, down. And then if you look at that minor downtrend line I gave you a few days ago right here, minor uptrend line, I'm sorry, we broke down. We've been back testing from below. So I don't have the highest convictions, but I still, my convictions are about the same as before. That we get that one more thrust down, probably to this area right here, at least 105, 288. If that happens, that will most likely bring gold, silver, and the stock market, which I showed you has been positively correlated with the euro since this bear market began. So all these things kind of coming together. Like I said, if I'm right, and remember, I told you before, I don't have any position in the euro. Sometimes I'll trade the euro, the dollar via, futures. But they're correlated trades, and they can have a disconnect. But for the most part, my whole, overriding theory is, and you can game the little minor bounces. That's what I do with the futures and all that. But, the near-term trend, I think, is still down in the stock market, the euro. And if that happens, we'll probably see treasuries go up. That would mean gold and silver, some more pressure. Although I did tell you, I don't have anything in gold right now, the ones I like the best, the most constructive charts are platinum. I gave you that just yesterday or today. Platinum here at support, and on the 60-minute chart, you have you can see that support real well. I'm very oversold there. And then silver, SLV is your silver ETF. That's the one you have the positive divergence there. The problem with it and why I can't get too bullish on silver is I can't make a very strong case on gold. I just made a case that if the euro does drop, It's probably going to bring gold and silver down with it, and these divergences may get burned through. Maybe, maybe not. A lot of times when I ignore things like this, they just go on to play out, and I'm kicking myself. But again, I'm fine with that. If I trade, I'm not comfortable with it. Just pass. Gold, like I said, gold looks okay, but not great. I take that back. Did add that divergence, but it's not at support. I always say divergence is not a buy signal. Divergence tends to extend, and then divergence at support, that's where I like to buy. So maybe we get that. But if that happens and that euro plays out for a much bigger drop, I'm just highlighting these gaps right here and that support level at 175.39. We could get another leg down. There's really on the daily chart, it's not as, this is kind of ugly. No divergence on the daily chart. We're in a confirmed downtrend. Here's a big old gap right there. This is GLD daily. And so again, I can't get too excited based on the daily chart, nor based on my outlook and expectation for the euro and the stock market, which again, kind of tying all these in as correlated assets. That BYND trade, I haven't updated much since last week, the week before last, when we topped in the stock market. That was my last update. I said, look, I think the market will be down next week, which it was. That was last week and this week. And so that would probably take Beyond, prevent Beyond from rallying up more. It's above the breakout point, but it's kind of stalled out here. And, you decide if you took it there, you want to give back all the profits. That's what I said when we were up here. You don't want to let a nice winner, it was double digits, turn into a loser. So I'll leave it on unless it takes out that entry point. And there's still the max or the preferred swing target is that downtrend line, that 1527 area. But as I told you about on the 60-minute chart, you really hit the minimum. That's the first resistance right here on the 60. And so if we get another thrust up, that would align with the that resistance on the more significant daily chart. I'm going to keep this short, wrap it up here. No change in the big fangs. Got to see Apple and Meta break down, especially Apple. Until and unless Apple breaks down, the stock market will probably continue its slow grind, maybe even a sideways slog. So far, like I said, it's been a relatively slow and somewhat steady and orderly grind down lower. There's your downtrend like that. And yeah, that could be it, but I doubt it. Big 60-minute divergent high like that to me indicates more downside, like at minimum that uptrend line, and quite likely hit that uptrend line and have at least a minor reaction and then ultimately break below it. So that's how I see things today. I'll be on the road tomorrow, and then just getting in late, and so unless something big happens, I'll probably get the first update out to you on might be Friday, probably Friday before I get anything out to you. Maybe on Thursday. We'll see. All right, guys, I'm going to wrap it up here, and like I said, I'll get back to you as soon as I can. This has been Randy Finney with Right Side of the Chart. Have a great